Okay, well, good morning, everyone. I am Peggy West. I'm the organizer of today's Construction Summit. We have a great webinar started here or getting presented today by the Building Solutions. It's called, I'm looking for the title here, Uros, I'm sorry, From Panic to Plan, Budget Season Survival. And I'm very excited about this because a lot of projects are going on, and this is going to break it down for you very seriously. Uh, we do have some housekeeping items. First of all, for all of you managers out there, please allow him 7 to 10 days to post your credits. I know this is very important at this time. We're coming up to renewal for our licenses, myself included, but give him a few days. It is Friday to get those posted next week and then maybe the week after. So hold on your phone calls and your emails, please. If you have a question today, put it into the Q&A box. Please don't put it into the chat box. The chat will be for our sponsors today, and they will be entering information regarding how to contact them. And then following, I will send out a sponsor sheet. And this includes any questions regarding the presentation today. Uros from StoneBuilding is going to probably respond directly on a private email. So feel free to put your email address in there as well. Uh, with that, I want to go into our sponsor introductions for today. I'm going to start out with Janik today, just to do a brief introduction. Diego, if you want to tell us about what your firm does and why are you on this construction summit?
Yeah, of course. Thank you, Peggy. My name is Diego. I'm with Vasiljevic. We are a Florida-based boutique law firm with powerhouse capabilities. We focus on construction, defect litigation, and first-party insurance recovery, helping property owners and community associations protect their investments. We recover more than 1.25 billion with a B for our clients and handled hundreds of complex cases. What usually sets us apart is our approach. We combine deep experience with a dedicated hands-on legal team, so our clients have the strategy, communication, and support they need from start to finish. With that, I want to introduce to Stephen Hoffman. He's one of our attorneys and head of the Fort Lauderdale office. And thank you very much for coming.
All
Enjoy
right.
the panel.
Thank you so much. Okay, awesome. And then we'll hear from Steve here in a little bit. Next, I want to introduce another panelist that we have on today, Kathy Naughton. She is a vice president for Valley Bank. Kathy, tell us what Valley does, please.
So Valley is a nationwide $47 billion regional bank. I work for a specific vertical, and all we cover is condos and HOAs. That vertical alone has 100 or $1.6 billion in deposit. We provide financing for projects such as these that are coming up. Valley's Association Loan Department has done about $100 million in loans working on projects over the years. So we've got a really great honed in department that is ready to help with any kind of financing needs with the projects that are going to be discussed today.
Okay, awesome. Okay. Next, I want to introduce, I see we have Cameron on today from Best Roofing. Cameron, you want to say hello and tell us what you're doing over there at Best Roofing?
Good morning, everyone. My name is Cameron Andres. I do business development for Best Roofing. We're a commercial roofing contractor based here in Fort Lauderdale, Florida, servicing the entire state for the past 48 years. We can handle any and all kind of roofing issues you may have. So we can do small repairs on single family homes all the way up to big re-roof projects on commercial buildings, as well as preventative maintenance plans. We do recoveries as well. So anything and everything roof related we can handle. We do also offer complimentary comprehensive roof audits. So if you want to get somebody out there, take a walk around, see if there's any repairs that need to be made right now, be happy to do that for you, as well as give you a life expectancy of your current roof system and a cost associated with a re-roof. So you have that in mind when that time does come down the line. So if that's something you're interested in, please let me know and I'd be happy to set you up with that. Enjoy the panel.
Great, sounds great. All right, this is still a good time with hurricane season, kind of early in the stages, but coming at us if we have a storm, usually coming in late August or September. So here we are. Uh, Also, I want to move on to introducing Erin Nickerson. She is with WRG now. Erin, tell us about yourself and what are you guys doing?
Good morning, everyone. Thank you for joining us this morning. My name is Erin Nickerson, and I'm the Senior Account Manager for the Water Restoration Group. We are a licensed general contractor that deals with those hurricane damages and your day-to-day fire, water, mold emergencies, all of the bad things that happen to the interior of your property, especially when you have construction issues allowing water intrusion in. Thank you for having me, Peggy, and I hope you all enjoy today's webinar.
Good. All right. Next, I want to introduce Vice President of Community Services for Faster IO. We have Bob Aleka on today. Hey, Bob, how are you doing today?
Good. Thanks, Peggy. Hello, everybody. Good morning. Good morning. Like Peggy said, I'm VP of Faster IO. We've been building, designing, and managing fiber optic systems for over 25 years. Today, we're introducing a new system that we're putting out for condominiums, which is called a community Wi-Fi through the entire community, which means if you're in the hallway, you're in your unit, you're in the pool, you're in the garage or the parking lot, it's one system that the resident can walk around and not constantly log on and log off. Plus, it's an AON system, so everybody gets their secure login, but they can still walk around the entire property or walk back to their unit. It's especially interesting for AI as well as home automation. It makes everything much easier than everybody logging off, logging on, and having a router in each unit. And we can do anything from 20, 30 units up. So if you're interested in getting some more information, I'll put my information in the chat and give me a shout and enjoy the class. Thank you, Peg.
Yeah, thank you. All right, we have a few sponsors that are not able to get on today. I'm just going to run through them real quickly here. We have Clarkson and Varick. They are elevator consultants. We have a rep based out of the Miami, Florida area that covers all of Florida, Damaris Cabrera. She will be on the sponsor sheet. We also have Southwest Elevator. They are an elevator installer. So I guess first you want to go to your consultant. If you have maintenance and so on, you might want to go through Southwest Elevator for maintenance practices and get up to date for that. The contact there is Brooke Cavender. We also have City Quiet Windows and Doors. The president there is Ben Friedman. Ben has been in the industry for a long time. They have 4 offices around the state, and he has everything to do with windows and doors, new construction included. Then we have Hafer Company. They are a full service CPA firm, and Hafer is based out of Palm Beach Island. However, they do have 4 offices around the state as well. I don't want to discount at all my Wind Beneath My Wings is Vinteum software. They are on today. I want to say thank you to Paulo and your team inside, and I'm going to talk to Carol here. Carol, tell us about what Vinteum does for associations.
Okay, thanks, Peggy, and hi, everyone. I'm Carol with Vinteum. For those who may not be familiar with us, we're the team behind Neighbors, a platform built to make community management a little easier for boards and property managers. And I think there's also a really nice connection between what we're discussing today and what Neighbors does. A big part of managing projects and budgets successfully is having good records, knowing where things are, and making sure the right people can access that information when they need it. So that's something we focus on a lot. With Neighbors, your community can keep important documents, communication, meeting information, and other records organized in one place rather than having everything spread across different systems and inboxes. You can also use it for your community website, resident communication, visual meetings, and more. And since we know everyone does not want to spend their day figuring out new technology, we've designed it to be pretty straightforward to use. Plus, we don't just hand you out the information and leave you on your own. We'll help you set up everything in your website and portal and provide training for your team and also residents. We offer ongoing support whenever you need it. So if keeping your community's information organized and accessible is something you're working on, feel free to reach us out. We'll leave our information in the chat. Thanks, everyone, and have a nice webinar.
Thanks, Carol. Awesome. Awesome. Okay, and with this now, I'm going to turn it over to today's moderator to introduce himself. We have Daniel Baum on from COA Solutions. Daniel is a full service brokerage for associations. And thank you, Daniel, for moderating today, and I'll let you take it away.
Thanks, Peggy. My pleasure. Good morning, everyone. As Peggy said, my name is Daniel Baum with COA Solutions. I specialize in helping condominiums and community associations navigate their insurance and risk programs. Our topic today, we're talking about budget seasons. It's obviously much more than just insurance, but insurance certainly represents a significant portion of the association's operating budget, and major construction projects can introduce an entirely new set of risks. My role is to help boards and managers understand those exposures, make sure contractors are properly insured, and structure the association's coverage so that one unexpected event doesn't turn an already expensive project into an even bigger financial problem. I'm looking forward to moderating today's discussion and bringing all of these perspectives together. And with that, I want to jump into our webinar number 8 for our construction summit, From Panic to Plan, Budget Season Survival. I'd like to introduce first our panelists that will be having our conversation today. First, we have Uros Vasiljevic, if I didn't butcher your last name, Uros, CEO of StoneBuilding Solutions. Uros and his team work with condominium and community associations on structural engineering, reserve planning, construction oversight, and owner's representation. He sees firsthand what happens between the numbers that get put into the budget and what a project actually costs once the walls get opened up and construction begins. So he's going to help us understand how boards can plan better, identify problems earlier, and hopefully avoid some very expensive surprises. Next is Stephen Hoffman, Special Counsel with Vasiljevic. Stephen has spent more than 2 decades handling complex construction defect cases on behalf of property owners and community associations, and recovered more than $100 million for owners dealing with defective construction. He brings the perspective of what happens when a project goes wrong, and more importantly, what boards can do before and during a project to protect themselves and avoid ending up in that situation. Welcome, Stephen.
Thank you. Good morning.
And finally, Kathy Naughton with Valley Bank. As you heard from Kathy a few minutes ago, Kathy brings a particularly valuable perspective because she's worked on several sides of the community association industry. As a community association manager, a board member, and now in association banking. She understands not only how a board creates a budget, but how an association actually funds major projects, manages reserves and cash flows, and deals with financial reality when the project costs more than originally anticipated. So between engineering, construction, legal risk, and finance, we should be able to cover this topic from just about every direction. Ladies and gentlemen, we are going to be taking your questions throughout our presentation this morning. I want to remind everyone to please put your questions in the Q&A box, as it's much easier for us to monitor than the chat function. And I will ask our panelists those questions as we go along. With that in mind, I'm going to turn the floor over to Uros and let him take it from here.
Thank you very much, Daniel, for the wonderful introduction. And once again, good morning, everyone. I'm very excited to be here. Once again, Peggy, thank you for hosting me today. This is an exciting topic. This is a very educational topic for everyone attending. And again, we're in budget season, okay? We are in hurricane season, budget season, construction planning season. There's a lot of things in the air when it comes to condominiums, and I hope to make this very engaging and interactive. This presentation is going to be divided in 3 parts. The first part, it's all about the rules and what we're looking at when it comes to budget regulations and funding your reserves. The second part, it's all about capital oversight or capital improvement projects and looking at those things proactively as an association, as a board and membership. And then the last part, it's really about sequencing and what is the right way, the proper way to look at running a community project, a restoration project for your community. So I'm going to go ahead and share my screen and hope to really make this interactive for everybody, like I said, and educational above all. Peggy, can you guys see my screen? Yep. Okay. All right, everybody. Again, this is an HR CEU. It's a 60-minute webinar. From panic to plan. Okay, we're talking about surviving the budget season. looking at the traditional reserve studies, the structural reserve studies, and then the new lending reality that's happening in Florida. So, one, I want to start off just with a very recent bit of news that came out on August 3rd, which is that Fannie and Freddie basically uh, retired limited review. Now, what's limited review? Limited review was where there's only a superficial, so to speak, look at your reserve studies. Now there's a full review. What does that mean? That every condo loan on the consumer side will run a full review. Okay, so that means that the lender looks at your reserves on every single file. And that's in effect. And I'll talk a little bit about why that's important and how it impacts the overall market. And then there's also, starting on January 4th of next year in 27, there's a new change which went from the minimum reserve line goes to 15%, and it used to be 10% of what you collect in assessments every year. Now, the title is kind of catchy, right? It changed everything. And mainly because baseline funding is no longer accepted. And we'll talk about the ramifications of that. So here it is, right? So the quick review on the limited review is gone. Okay, older buildings will get the full review, and basically only projects of 10 units or fewer can skip it. Now, baseline funding, the biggest change here for everybody is funding just enough in your reserve account just to keep the account above zero will no longer count. Okay, so moving forward, based off of Freddie and Fannie, highest recommendation controls. So that means that if the lender uses your guys' reserve study as an association, your budget has to fund the biggest number in it. So whatever your reserve specialist, your reserve professional recommends in that funding plan, that's what needs to be taken into account and what needs to be included in the budget. So studies, of course, they must be current. If you have a reserve study as a board that's over 3 years old, that will not count. And basically, in that case, you'll be on the flat percentage test or you'll be out. So how does this impact further on? And guys, this is a little bit of a deeper point here. It impacts the entire market, okay? Because 50% of the buying pool, more or less, in Florida needs conventional financing. If we take that out on the consumer side, obviously the values drop and basically the buyers drop. So really kind of looking back into the last few years, historically, the government, they kept finding the same thing over and over again, right? It's that the associations, the buildings that skip reserves or waive them or kind of kick the can down the road a little bit, those are the associations those are the buildings that need the big repairs. So they found a correlation between underfunding and capital improvement critical stage, right? So now the big shift that's happening in the industry is that every study is read by a lender. It is a lending document. It's not a planning document. Again, banks are really tightening up and looking at these things a little bit more closely. So what are the stakes? And the stakes are very simple. You can no longer underfund, basically. Bottom line is it's no longer just a special assessments. It's that your owners in your association may not be able to sell. And this is what will basically set unit values over the next 3 years when you look at conventional financing. So it's a pretty big change. It was kind of subtle, flew under the radar a little bit, but it is a big, big effect. Kind of taking a little bit of a zoom out here for everyone. And when we look at Florida condominiums, right, there's 2.2 million units in our state. And there's 3 pillars. We always talk about the 3 pillars that rule Florida condos. Okay, that's politics, insurance, and banking. And when we look at the political side and kind of how all this came about, the tightening, right, the scrutiny over the condominium market, we all know what happened at Surfside in June of 2021. 98 people. It was the 3rd deadliest structural engineering failure in United States history. Obviously, the state came together. Both parties created a new law where it got passed in June of 23, where milestone inspections for 3+ story condos, 30 years old, SIRS, which is obviously the structural integrity reserve study, and the reserve funding, right? That's the floor. That is no longer the ceiling. That's the floor. That's the minimum that condominiums must do, because the state basically said, we will no longer allow things like tragedies like this to happen. So basically, it's a little bit of an unfortunate reality when it comes to the cost side of things, and we'll talk about that, and we'll talk about actual strategies to alleviate and to plan ahead and to really minimize what you need to put out every year when it comes to budgeting and funding. But again, condominiums, they no longer get a vote on whether these laws apply to them. They just have to follow and abide. So really the big takeaway on the politics is that the state is really not moving. There's a lot of conversations in 2024 and 2025, whether there's going to be extensions, whether there's going to be some kind of minimum thresholds applied. They're not. Right. So basically, you have to follow the law, and insurance on that side. And I'm sure, Daniel can contribute here as well. But, every claim, every property damage insurance claim, every job that you put off goes in their file, and they're basically scoring your building. The insurance carriers are. So the soft market that we have does not mean that they stop watching the insurers. And then last but not least, again, we just saw it with Fannie and Freddie, banking. The banking industry decides if a buyer can get a mortgage in your building. And so no loan means cash buyers only, which on the other side, how that relates to is that every owner's asset gets quietly repriced. And that's kind of something to look ahead and to really pay attention to. So moving forward, we'll talk about part one, right? The rules. Again, what's at stake? What's going on? What do we have to do when it comes to our budget requirements as an association? When it comes to our traditional reserves, and then our structural reserves as well. Okay, couple things. Let's start with the budget regulations for everybody. Peggy, do I see a hand?
Yeah, I just wanted to make a comment that just happened recently. I had a very good friend who lost two buyers, not one, but two buyers that they could not, purchase because the condominium was not properly funded. So this is huge. I mean, I think it's a lot to jump from 10% to 15%, first of all, but she finally, the financials weren't provided either. So there was another record keeping issue. Which goes to having the website with the correct files, etc. But at the same time, not being fully budgeted or reserved properly, really affected. She lost two sales, and actually her third sale, the final sale, was less. She had to take less money at the end of the story, but just a hardship because the board doesn't have the records caught up.
100%. I mean, I couldn't agree more. And we actually see that day to day. We have deals that are stopped at the closing table because of that. And we see situations where the association does not have their structural reserve study. And of course, there's no lending. And again, it affects them adversely on the insurance side as well. So it is a very evasive effect. But thanks for that story, by the way. So going back to the budget regulations, really, once again, notice in the meeting. So there's notice deadlines and there's open meeting rules that now apply, where you're looking at really what's the new wave of budgeting and how we're going to come up with these reserves, and really the voting side of things. So the voting, funding less than the full funding takes a vote of the membership. Okay, this is another change that happened. The board alone cannot decide it. And fully funded, this was one of the topics that I've been a part of many webinars, and it's a lot of questions on this particular topic. Really, what is full funding and kind of how it comes about, right? So the board is basically responsible to put a fully funded budget on the table. That is the starting point, which means that to put it quite simply, and I might be oversimplifying it just for the purposes of the webinar so we can move on, but let's say you do have a re-roof and you have to replace your roof, which costs, let's say just for a round number, costs $1 million, and you have to do it in the next 10 years from now. Full funding doesn't mean obviously that you need to have $1 million in the bank today or in 2026. It just means that you need to have a plan in place where starting now each of the next 10 years, you're putting aside $100,000 in order so that when that day comes and it's time to really replace, you have the funds available because it is a critical structural item, as everybody knows. So legal review, now it's also included. And again, your own documents as a board, they may have separate and additional rules. Definitely consult your legal counsel there on the condo. And then a couple thresholds here on the reporting side. So if you're over $300,000 in the annual revenue, that will require a financial review. And then if you're over $500,000, it will require an independent CPA audit. So that's some of the fundamentals and the basics of the new budgeting regulations. And again, here we have the differences, right? Everyone always goes back to this. What are the differences between a traditional reserve study and a structural reserve study? What goes into it versus not? So on the traditional reserve study, this is again the one that's always been there. It's not legally mandated. All building types and elements, okay, common area elements, etc. On the SERS side, you actually get 3+ story residential condos. So again, on the items, structural, both structural and non-structural items. And then on the SERS, you have to do structural items only. There's 8 of them. Preparer, who is in charge of preparing this for the board? For the traditional reserve study, you don't need an engineer or a reserve specialist. And then on the SERS, you actually do need a structural engineer or an RS, which is a reserve specialist. Funding, there's no funding requirement except what we already mentioned. And then fully funded on the SERS, which is starting in 2026 as of January. I know we're almost 9 months in, but that's been in place this year on the full funding. Timing, it is document dependent, the traditional reserve study. And then when it comes to the SERS, basically you had December 31st of 2025, and then every 10 years to get an update on your structural reserve study. Either way, traditional or structural, you must fund the biggest number that is recommended by your reserve professional in that study. Okay, here we're going to talk a little bit about what changed in traditional reserves for condos. Structural items have to be on the schedule now. Number 2 is inflation. Obviously, prices go up every year, so the traditional budgeting plan has to show for that. And then the mandated, number 3 is the mandated inspection cost. That includes inspection fees from professional services that have to be budgeted as well. And then the last, but not least, interest, right? Interest you earn on the money will count and needs to be included. So pretty straightforward on that. We're going to move forward. So setting up the SERS. And again, this is before you draft your budget as a board. Three big decisions. Okay. The first one, where does the money go first? Okay. As a board, what do we have to look at urgently? And that's going to be the urgent repairs. Okay. The SERS and the non-SERS. And then of course, structural items. Okay. We're talking roofing, walls, windows, doors, plumbing, electrical, fireproofing, all of the structural items, waterproofing, they have to come before anything cosmetic. Now, the second decision as a board, is this going to be component funding or pooled funding? That will basically decide if you can move money between line items without a vote. So again, that's something that we've had a lot of questions on, and it's a decision to be made before drafting. And then the last one is pretty simple. What can still be waived? Owners can vote to waive regular reserves. A glide path on SERS will buy you time to fund the money. Basically, that's almost like a proration on your budgeting for the SERS. So there's still solutions. There's still things that are available to every board. The biggest takeaway is you just have to plan for it, and you have to know what you're going into before budget season.
Uros, if I may interject for a moment, I got a question for you. So when you're referring to the guidelines, underwriting guidelines, the question basically is when it comes to reserve funding, is that only the SERS or the law? Let me read it like this. When you say underwriting guidelines includes reserves be funded, that is only the SERS like the law, or is that all building, all stories reserves must be funded for the banking review? This is specifically when it comes to the Fannie Freddie question.
All condos, all stories. That's the simplest, shortest answer there, Daniel. Appreciate the question. Yeah, it
Thank
is
you.
for everybody. Yep. Okay, moving forward. What if owners do not vote? No vote based on the latest regulations that we have. No vote is still a vote. Okay, so silence is not a waiver. No affirmative vote to waive means the members have spoken and that the association must fund. So this is something to obviously keep an eye out and really internalize as a board. And now we're getting into part two, right? So we've talked a little bit about the rules and the regulations. Again, this is not the first webinar on that. There's been plethora of information out there in our industry about what are the new requirements, the differences between traditional and SERS. The biggest takeaway is that all reserves must be funded. And again, on the consumer side, I just want to bring another reminder of the new Fannie and Freddie regulations that came out on the consumer side where, again, it is no longer limited review. It is moving forward. It is going to be a full-on review. And again, that can drastically impact the values of units and also the buyer pool, right? Which is going to bring down some of these prices. So again, banks are really tightening it up, and they're following, again, that third pillar. They're following into the footsteps of the political pillar and the insurance carriers. And again, this is just the reality that the better we are prepared, the more we know about these things, the better ahead the outlook for us as condos. So the second thing here, I want to talk a little bit about the plan. Okay, so what can you do as a board to really prepare yourself and to have a nice, coherent presentation, and then to start funding, which is really the topic of not only this webinar, but every board meeting moving forward over the next couple months. So critical elements for everyone, basically the 3-year outlook. Okay, so take a breath, take a pause, and look at what the next 3 years are going to bring for the association. Okay, so what we have to really account for. Number one, that's going to be the fully depreciated items. Okay, we have to basically look at any one of these 4 elements that you guys see on the screen as if you fail one of them, it has to be included over the next 3 years because it's really the most urgent and immediate outlook. So 1 is fully depreciated items. 2 is unsafe items. Obviously on the structural engineering side, something that's unsafe. We day in and day out at StoneBuilding Solutions, we deal with roofing projects, concrete restoration, balconies, stairwells. We look at things like roads, also plumbing, internally plumbing, HVAC, electrical, right? So these are some of the things that you have to start thinking about safety and also building code violations. And then number 3, it's items that cost more the longer they wait. What do we mean by this? Things like a small repair on your roof, or things like a concrete spalling on the balconies that's not sanitized early on, or it's not solved early on. It becomes a huge headache for a lot of these boards that we're helping down the road, and it's 10x, 20x, sometimes even 30x the cost. Preventative maintenance versus reactive maintenance later. And then last but not least, anything that will drive insurability, anything that puts you in good standing with your insurance carrier, that has to be included. So that's the 3 years. And then again, let's talk about the documents. What documents a board needs to prepare a budget. There's 10 documents really that are needed. 1 is the P&L, the profit and loss statements. 2 is the current budget for the association. 3 is the prior year financials. 4, contract summary sheet. 5 is the reserve study and the SERS. 6 is projects in process, things that you have going on right now. 7, required repairs and insurance upgrades. 8 is desired capital improvements, things that we mentioned a little bit ago. 9 is expected insurance rate changes. And then 10 is required building code work. So The board must send it all ahead of time, and a board that shares the inputs rarely has to defend the answer, right? So anything that's shared, and again, I'll take it a step back, where in the summer of 2025, last summer, we saw with HB 913, which really the bottom line of that bill was all about transparency, right? The Florida Sunshine Laws, where everything has to be put out in the public, including the voting requirements for condos that are 25 or more units, have to have a website, have to have e-voting available, etc. This is along the same lines. Okay, let's really get our documents in order to be fully prepared to prepare a budget. Okay, the budget meeting itself. This is where we also see a lot of nuances and a lot of some boards do it better, some boards maybe scramble a little bit, but that's okay. You know, we're here to help. So the mechanics, send the materials out early. Okay, basically you have to have an agenda with times on it and what's going to be a part of the meeting, and then also a formal recorded vote. And so the evidence on the other side. So what you checked and how, the critical items, what are the critical items that the board looked at and why, what's the timelines, what's the sensitivity there, where the pricing came from. So again, any RFPs, any scope of works, anything that you've gotten before, line items list, etc. And a professional in the room. Okay, so, and then also what you actually spent last year, okay, as a board. So this is basically the bottom line here for all of our members, is really just, let's use data. Let's use data to really power our decisions and have a organized, productive meeting. Okay, we're getting into part 3, and this is where we're going to spend a little bit more time today to talk about the capital plan. Okay, some of the things. Yep, go ahead.
Sorry, before you jump into the third part, I have 2 questions that go back to budgeting and Fannie and Freddie. You want those now?
Sure, absolutely.
Okay. So first question from Dennis, are items on the reserve study that are priced below the $25,675 floor included in the funding requirements?
So is he referring to the SIRS?
I guess he doesn't clarify on it. That's the extent of the question.
Yes, the answer is yes. Anything that's part of the 8 elements, which that belongs to, that one specific case is part of it on the SIRS side, it has to be funded.
Okay. This is sort of a follow-up to that same, this 25,000 on threshold for both SIRS and non-SIRS or funding study. Can we do both SIRS? Okay, so follow up on that, is the $25,000 threshold for both SIRS and non-SIRS reserve funding study? And can we do both SIRS and non-SIRS every 10 years?
So the SIRS is only the SIRS is every 10 years. The traditional study is recommended every 3 years. And again, this is something that the 25,000 threshold would not be included. And but again, this is one of the things where the more you change, the more you do stuff on your buildings, the more capital improvement, and the more that the budget changes, obviously, the more the recommendation is to really do an update. You know, at StoneBuilding Solutions, we do updates. We look at 2.5 years after the traditional study, and we start reaching out to our past clients, and we look at updating that reserve study. The difference is that, you know, the second time when we come out, obviously we don't really need to send an engineer out. We basically already have all the documentation for the association. We already have the first reserve study that we did, and we look at just the changes on their budget and what was spent.
Okay, and the Fannie Mae and Freddie Mac reserve guideline applies to all types of purchase mortgages?
This is for conventional finances. So this is just for on the consumer side. Again, traditional association financing, and I'm sure Kathy has a couple insights here, that remains unchanged. There's plenty of options for condominiums. There's specifically community banks right now, and that is a separate conversation, right? This only impacts consumers looking to get a loan and financed by Fannie and Freddie, and looking to buy a unit into an association that does not have the reserve study completed.
Kathy, do you want to add anything to that? I think you're muted. There you go. You should be good now. We still can't hear you.
Kathy, bottom left, there's a mute.
No, her mute is off, but for some reason her mic's not picking up her voice. She was kind of quiet in her intro earlier, so I'm wondering if it just might be an issue with her computer. All
Paula,
right.
can you help with that?
Kathy, I'll come back to you on that question. Okay.
Maybe if she, yeah, maybe if she tried to get in again, it can work.
Kathy, you might want to exit the Zoom and come back in, I think is what she's saying. Okay, thank you.
Yes.
I'll continue with a few more questions here. With the new requirements for staying under the 15% increase threshold, are reserves pulled from the increase when making the calculations?
I'm not sure I understand it. Can you read that one more time?
Yeah, the question is, with the new requirements for staying under the 15% increase threshold, are reserves pulled from the increase when making that calculations?
So I'm not really sure how to address that question, right? Because this is something that just came out literally a month ago. We'll have to see what the actual really what the actual policing is on that side. Again, the biggest thing is if you're a condominium association less than 10 units, it goes up to that 15% and from the 10% before, and that's basically what they're going to look at. Again, this is just on the conventional financing. This is not for the association financing, the Fannie and Freddie. So the big point is that it drives the unit values down over the course of time, right? Not necessarily affecting the condominium association funding.
Okay. I have Tara. We have Tara Stone jumping into our Q&A, throwing in some answers. Hi, Tara. Nice to hear from you. She says things under 25K would not be in the reserves, so would not be required. And then Fannie and Freddie is standard underwriting guidelines for conventional lending. There's still jumbo and non-conforming loans that have their own regulations. This is underwriting standard for 70% of all loans. And the 15% standard begins in January of 2027. So Tara, thanks for jumping in and helping out on those. Kathy, did you want to add anything else? Can we hear you now?
You tell me, can you?
Yes, we've got you.
Awesome. Thanks for the solution. The banks do look at your reserve studies. They want to know that you know what's coming up next. They want to know that in the next 10 years, if you're going to owe a bank a couple of $1 million as an association, and you've got multiple other projects that are showing on the reserve study, they want to know what your plan is. And as an association, how are you going to address those items during the course of the repayment of the loan? So while, yes, the Fannie Mae and Freddie Mac stuff is consumer, just know that the banks are looking at these reserve studies and, do the projects. We can fund them, do the projects. It brings your number back to zero, right? On your reserve study for funding for future. We're happy to help, but we are going to look at your reserve studies.
Perfect. We have a clarity on that earlier question, Euro. The 15% budget total increase, operating and reserves, to not have to produce a second budget, are reserves and insurance pulled from the total budget to calculate the 15% threshold? And Tara jumps in and gave some more insight. I'm not sure if it's on the same topic though, but Euro, does that help clarify it all anymore?
Yeah, it's just the 25,000 rule replaces the old 10K rule, right? So that's what basically is they're saying, right? It's just a minimum amount. And again, it's the biggest takeaway is fund whatever is recommended by a reserve professional, the highest number. That's the whole point of the full review versus the old limited review.
Okay, let's feel free to continue on. We can pick up more questions later on.
Can I just make
Sounds
one
good.
interjection though? To echo Kathy, is that I would encourage everybody who needs to do any sort of a safety improvement to do that, because that can only go to greater property value. So, when you're selling, no matter what type of loan, if you can say to a new buyer, hey, we're improving the roof, we're improving the decks, or whatever you're improving, that's only going to go to a greater property value. And even if you're not moving today, if you want to 10 years down the road move, this has all been done, and it just increases your property value.
Excellent point, Peggy. Absolutely. Okay, here we are going back to the capital plan, right? Really what this funding should be for. In the past, we've looked at condominiums, really focus on the cosmetics and the non-structural items, obviously to preserve that long-term value of units. That was the overall kind of mentality there. With the new regulations, that becomes a little bit more of a challenge. And of course, the big focus is on capital improvements and really the structural things that as a board, you have to address on your building. So we'll talk a little bit about sequencing and then lead times, which is something that, again, on the construction side, which is really our expertise at Stone, we really don't see a lot of people talk about it and consider it, given where the market is with pricing, with insurance premiums, with, again, on the construction side with labor and materials, et cetera. So supplying and manufacturers. And then the last thing we'll talk about here in the part 3, it's the cost of waiting and some live case studies and stories that we see from associations. And thankfully, we're able to jump in and help. But again, there's a huge difference between being preventative as a board and then reactive later down the road. So let's dive in. First, we'll talk about a real life. This is, again, a case study from StoneBuilding Solutions, Pedro, board member. Again, this is, and of course, I'm going to leave the final introduction of Stone for the end and kind of tell you a little bit about the history briefly. But we come from the insurance claims background. Our company does property damage insurance claims. And this was basically a Hurricane Irma settlement for this board. Their insurance carrier offered them zero. Our public adjusting side, our public adjusting units were able to recover $11 million for that board. Again, this is not an easy process. It took almost 2.5 years on the claim to be able to get that settlement. But basically, once the money was there, the first priority for Pedro's board was really looking at the roofs on 41 buildings. It was a big association. And basically what happened, right? The board found a contractor, they took bids, they signed, selected a contractor at the end, and then wired a almost $500,000 deposit. 30 days later, the contract was canceled. And there was a big issue and a problem with the licensing. So again, the lesson there is the cost is, what happened next is 3 years of litigation. There was no recovery. There was deposits, legal fees, escalation, and then again, all throughout their buildings, their roofs were still exposed. And so basically roughly $1 million spent once after the initial fee and everything else they spent in litigation with nothing on the building to show for it, right? So again, we got them the money on our claims division, but nobody was standing next to them when they spent it. And this is where hiring a licensed professional, a professional with, I want to say, at least a decade of experience, 10 years of experience in the arena is just paramount. It's very, very important. These are some critical times where there's a lot of liability being tossed around and there's a huge magnifying glass on the multifamily market. So it's very important to get an advisor, get a trusted professional, even if it's just an advice, do a free consultation, etc. So let's talk a little bit about how boards hurt themselves. Okay, and these are some things that we see day in and day out. Again, I want to remind everyone we've not gone commercial or government. So for the last 10 years, we've only strictly serviced and helped condominium associations and co-ops in the state of Florida. We opened up in New Jersey, but again, our audience, we deeply, truly know condos and boards, and obviously the property management side of the equation as well. So what we see constantly, okay, is not pulling the trigger. This is a big, kind of an innocent mistake in the beginning, but we see the ramifications day in and day out. Because for any board, I mean, it's normal. Waiting feels like we're saving money right up until it turns into an emergency. And we see this all the time with starting from little things like code violations to bigger things that are, impacting the life safety of the structure. So the second thing that we see often, and there's dozens of stories about this, is not paying for oversight, construction oversight. Okay. Really the lesson there, and we see it time and time again, if you skip the engineer and the owner's rep, somebody representing the interest of the board, the association, there's going to be plenty of surprises that show up over the course of the project. Like whether you're doing a roof or a concrete restoration project, stairwell project, obviously change orders are a very common thing that happens, unfortunately, and some of them are justified, some of them are not, right? But if you don't have an engineer or an owner's rep, which is what we obviously specialize in, really advising you and verifying every change order, making sure that number one, it is needed, and then if it is needed, number two, making sure that it's installed and implemented the right way. That's huge, right? That is a step that even one change order that's not justified, that we end up saving or preventing and stopping and telling the contractor, hey, this is not something that we're gonna go down. This is not a path that we'll take. That alone absorbs any kind of a consultant fee and any kind of an engagement from an engineering, owner's rep point of view. So really, representation. You have the right to hire representation as a board, and you should, is the point. So not paying for the right contractor. Again, this is a big lesson. We see boards hurt themselves with a lot of times when it comes to the second phase, which really for us at Stone, that's the sealed bidding phase, which we obviously guide boards with. We provide advice and guidance. This is where a lot of times the cheapest contractor, the cheapest bid will actually win the contract. What ends up happening oftentimes is plenty of change order coming from that particular vendor, and plenty of just surprises and things that maybe nobody anticipated when they looked at just the bottom line of the price. I see a hand from Steven.
Yeah, I mean the thing that comes to my mind looking at this slide is something my dad always says, which is you get what you pay for, right? And that applies if paying nothing, doing nothing. What I'm going to say now, I do construction defect. I don't necessarily focus on your planning, your budgeting. I'm more of, why do you need to budget that much? Why do you need $1 million for your roof? It's only 7 years old. Something I want our audience to know, and this may seem like a plug, my firm will predominantly handle our construction defect cases on contingency, which means you're not coming out of pocket. We're carrying our fees. We're carrying the cost. We're only getting paid if there's a recovery. It sounds like a plug, but I want our audience to know that exists. So as you're kind of analyzing these issues and trying to figure out what you're going to do, how you're going to do it, know that product exists out there for you. So whether it's my firm or another firm, you have the ability to retain competent legal counsel to pursue potential defect claims on contingency. I don't think everybody knows that. And it's a very valuable tool that could be used effectively for these types of issues.
I cannot echo that louder, Steve. That is a very strong point, and representation for the win. I mean, we see cases like this all the time, and it kind of reminds me of shop on price and pay twice. That's something that we say often here at Stone. And again, we understand where boards are coming from, right? We've seen them even before the Surfside laws. We've seen how the lifestyle and the management and really the decisions that were being made. So we understand where they're coming from. But again, we're in a time and place these days where there's a lot of scrutiny again, and there's a huge magnifying glass on some of these decisions that boards are making. We understand, obviously it's volunteers. It's a lot of folks that, are retired and may not have been a construction professional, or they may not have been a legal professional. But again, just always look at what's the catch, right? What's the catch? Look at the body of work of that specific vendor, whether it's on the legal side or on the construction side or insurance, right? Look at what they've done for condominiums specifically and some of the real case studies that they've saved money for the board. So it's very, very important. And again, the tricky part with these is that each one feels like saving money, but each one is also how you spend 1 million once, is making sure that you look at these things, you understand that, hey, we have a little bit of time, but we do have an issue. How do we think proactively? Let's go ahead and start the bidding process now. Let's go ahead and see what kind of costs we have facing forward in order to get this capital improvement project. Okay, here, sequencing. We're going to talk a little bit about some of the things that are in order of importance when you look at your capital improvement projects, and obviously funding for them. So obviously you have the big envelope items for every building, right? And that's going to be your roofing, your concrete restoration work. That is the envelope. Everything else that you have on your buildings, I highly strongly encourage to look at, scheduling around these two items, not ahead of them, but around them. And so you've got, again, roofing and concrete first, then you've got stairs, balconies, windows and doors. Obviously that has to come along with paint to be able to seal those openings and walls. And then you start thinking about inside, right? Elevators, HVAC, plumbing, roads, etc. Right? So, this is an important thing to kind of think about. And the next slide is actually going to kind of map it all out. So if you really look at budgeting for your association and you look at how to build a 10-year plan, just draw a line. Sit down with your board members, draw a line, and then every 7 to 10 years, it should be a cycle, right? So that you basically put on year 0, which is, let's call it 2026 today, you start putting in stuff. You start putting in roof, concrete, paint, the most important items. You start putting them not right now. Then you map out 7 years ahead, 7 to 10 years ahead. Again, same thing. Obviously, if you replace the roof, it's not every 7. In Florida, we're looking at, 15, 20 years, depend. There's a lot of factors that go into it. Obviously, insurance sometimes says even more than that. But again, you put the second batch of envelope in the next 7 years. And then you look at the third batch, year 15 and 20, same exact thing. So these are your anchors, right? If you draw a line, you put the anchors in every 7 to 10 years, and then everything else that you have as a board kind of fills in the blank. So roof, concrete, and paint is not optional. It's not a surprise. You should always put that top of mind as a board, and then they go on the line first. And then you fill in, right? You look at the other items, structural items in your buildings, things like railing, windows, elevators, plumbing, roads, your pool. Spread them between these anchor points so that not 1 year breaks you as a board. Basically, you have to fund through the roof, pun intended, right, for that particular year. Yeah, Steven, I see a hand.
Yeah, I hope you don't mind me jumping in with from my position. I mean, again, I'm coming at it from a different perspective. I'm considering whether somebody's legally responsible to pay for these issues, right? Other than the association, other than the board, right? You still got to you got to follow the rules, you got to do your funding, you got to do your reserves. But I'm coming at it from that standpoint. And looking at these lines, if I'm a board, if I'm management, I'm very, very focused on the first line, that year 0 to 7. The reason being is because of statutes of limitations, right? So if you're association and you are 0 to 7 years old, 7 years is the deadline for you to bring a claim. This is a silver bullet. If you have a potential claim and you don't bring it within 7 years of completion of construction, you are, or if you're a condo, 7 years of turnover, you're locked out of court. You are locked out. You are locked out. The keys are, under the courthouse, and you're never getting in. So obviously, follow these lines from Uros's perspective, on kind of maintaining and performing the necessary work. From the standpoint of a potential claim, you're really focused on that first line. Otherwise, you are, we have an uncomfortable discussion when you come to me and say, look, we got $20 million of necessary repairs and somebody else should be funding it. Somebody else should be paying for it. If you're beyond that 7-year mark, that's a very uncomfortable discussion, especially if within years 0 through 7, you could have done that in-house. You could have brought us in, you could have discussed those issues. And keep in mind, Uros is keeping an eye on that too. So if you're talking with him on any capital improvement, he's very, very versed on those issues too, and he's going to refer you to counsel as well.
100%. And again, that's the anchor points. Really, I couldn't agree more, because you have to look at the insurability all throughout, guys, as a board. Whether we're talking about the budgeting on the insurance side, it's all about really the 3 pillars. Again, it always goes back to it. What is the law? What do we have to do? And then how is a bank or how is an insurance company going to look at these things? So that's a very strong point there. Okay, so let's talk a little bit about here on lead time. And this is something that right now, obviously we're in wet season. It's a lot of talk about surplus or shortage, really, in this case, of labor, once that dry season begins. And again, just an example from real life day to day, guys, it's 8 to 9 months. You're looking at a lead time of 8 to 9 months just to get elevator or HVAC parts in hand. This is what we have going on right now as we speak. Material and labor. Okay, always look at the order date, not the install date, because there's all kinds of fluctuation there. On the engineering side, this is huge, because even if we really run, which we do at Stone, we're on a super tight ship, and we look at anything like 12 weeks from a moment that we do an RFP, which is a request for proposal, which is where we line out all the things that the buildings need to get repaired on, right? So all the repairs and everything else. From an RFP to a point of a sealed bidding process where we select a contractor to then go into permitting. I mean, even if we keep it extremely tight, you're still looking at about 12 to 16 weeks minimum. That is, and we haven't even began restoration work yet. So you always have to think about, as a board, you have to take these things into consideration very, very heavily. So trade sequencing, again, one trade without waiting on another trade is a cost line. It's not a scheduling note, and no project manager can ever help you on that. And then things like stairs, we see a lot lately. It's a big trap, because there's a long fabrication time, long installation time as well. So, one of the things that we've advised associations, and basically we've advised boards that, hey, you can kind of catch these things early, and maybe phase 5 stairwells per year on a 10-year cycle, if you have 50 stairwells in your on your buildings, right? And that way you start developing that relationship with the contractor. You have the same contract, same pricing. There's no emergency kind of in the air, and you really run a smooth project. So bottom line is, see it early, okay? Use a professional to catch these things early, threads, risers, all these things, and really start putting a plan in place. Hey, let's do 5 a year, right? Let's really look at cushioning that a little bit for our association. So lead time is huge. The envelope, okay? So this is the building envelope, really what the line item does not tell you. So some of the things that I'll share on this slide is really just case studies, live stories day in and day out in the field. Again, we're a practicing engineering company, right? We're practitioners. We're not like office stampers as engineers. So our whole entire engineering team is out there in the field, hanging on swing stages, really working, working on these buildings physically. So some of the things we see, on the roofing, basically what we see is, a lot of times when you talk to a board, hey, it's just a roofing project. We don't necessarily need an engineer. We don't need a consultant, an owner's rep. Guys, I cannot stress this enough. We see more construction defect on re-roofs or roof repair jobs than anywhere else. And this is just a day in and day out reality. We're in every pocket of Florida. We're in every small and big city. And there's so much construction defect on roofing. Even the smallest quote unquote jobs, there's all kinds of pockets of threats and things that you should watch out for, whether it's on the installation side, whether it's on the building code, whether it's on safety and OSHA standards, all kinds of things, right? Concrete, okay, this is where it's required with every paint cycle past 25 years. So if you have a building past 25 years, the more often you do things like concrete restoration, the cheaper it stays, the less you have to do moving forward. And it's straightforward. But again, a lot of associations kind of prefer not to think about it in the moment, right? So stairs, a yearly pass on the treads, the stringers and railing connections will cost a fraction of a replacement. Because when you look at a stairwell, right, it's what can go wrong? It can stay for 100 years, right? The problem is the connections. A lot of times water gets in where the fasteners are, and this is where you start seeing a lot of issues happening. And all of a sudden now we have to replace all of our stairwells instead of just doing a maintenance plan and looking at a yearly pass on all of these things. So, and then one of the last bucket that we see on the railings, again, they fail from inside out. I already mentioned the water gets in, fills the post, and the concrete connection goes first. So it impacts the concrete, it impacts everything around it. And these are things that you just won't see unless you're exposed to them. So kind of really sharing these lessons earlier and the better. The systems, we'll talk a little bit about the bigger systems, the windows, pipelining, plumbing, and roads. On the windows, oh yeah, Peggy, sorry, I just saw your hand.
No, that's okay. It just crossed my mind that, when you purchase a condominium, at least when I did, I had a condo a few years back. I had a home, then I went to a condo, then I went back into a home. You kind of move in with the idea of, oh, everything's taken care of, okay? And when you own a home, you always think about, oh, I've got to worry about my roof, but the gutters, all the little peripheral things, the fencing, the landscaping every single week and things like that. And a lot of that I think is kind of like taken for granted. When you move into a condo, you think, oh, I'm going to pay my $400 a month on my maintenance fee, everything's taken care of, and you just go about your world. And all of a sudden, there's this big thing that comes, uh, a cost to do a lot of these upgrades and so on. You say, oh, what happened? I thought that was covered in my $400. Well, yes and no. And I think this is where I would like to suggest to the audience that you have maybe town hall meetings, even once a year, but every 3 or 4, 6 months, and say, okay, guys, we've addressed this, we've addressed that, and talk about the maintenance items so that when they come up, you're not hit with, oh, what is this charge for? Why do I have to come up with $10,000 or $2,000 or $40,000? Because all along, this is the same as a home. Private residence maintenance, it's the same. It's just that on a much different scale because it's a condo building. I just think a lot of people misunderstand, why these charges are what they are and why they're a great deal higher, because you're not looking at one residence and that $400, $600. I mean, I pay $1,100 at a place I actually rent. And what does that cover? Well, it's not just the annual maintenance on the day in and day out things. It doesn't include the additional painting once every 7 years, 10 years. It doesn't include that roofing and the paving. Paving can be very expensive as well. But maintenance is something that I think when they changed the law a few years back where you didn't have to have a reserve study, and then they changed it back, you do have to have reserves now. This is where people are kind of like, I don't understand why we have to have this money put aside. And it's really to further suppress even more money that you might have to put out if you had no reserves.
Yeah, great point. Stephen?
Yeah, I mean, I was just gonna echo what Peggy, or I was gonna say what Peggy just concluded with. It's sort of like, it's very uncomfortable paying those monthly dues. It's very uncomfortable enforcing those monthly dues, but it has a purpose, and the purpose is so that you don't have to hit, a $10, $20, $100,000 assessment because you haven't done it, and that kind of dovetails exactly to what Uros trying to emphasize to the group.
Exactly. Excellent points there. So kind of going into some of the things we see on the bigger systems on the building, right? On the windows, really, oftentimes we find ourselves recommending if you actually do hurricane impact windows, let's say you have to replace your windows and you do hurricane impact, you might even obviously have savings on the premiums. You might have savings on the insurance side. You no longer need the old shutters, basically with hurricane impact windows. And again, looking at running the window replacements in cycle with your concrete work, not against it, obviously. So it's right there, goes hand in hand. On the plumbing, the two things that we've seen, obviously you have two systems. You have the water coming in and you have the drain lines coming out. And anything that's built before the year 2000 needs the drain lines looked at. And this is just the reality of the buildings and the structures. Pipelining, this is where it's another one of those secrets that we have really advised some associations and saved them a ton of money, where it's a third of the cost of replacement. And it basically buys the board another 25 years, right? So if you wait too long, obviously you're going to lose that option, but something to keep an eye out. And then roads, I know Peggy, you mentioned them, but basically after you do a refill, a rejuvenation of your roads instead of a sealant will actually cost more upfront, but will buy life of those roads on the back end, right? So sometimes it's kind of, spending a little bit more in the beginning if you already are doing the project to really buy yourself as a board peace of mind and really the useful life, really kind of push that replacement down the road. So that's important. Okay, the road that Pedro left early, kind of going back to our story from the beginning. This is where, again, we're looking at the 7 stages, okay, of what you need to do. If you look at a whole cycle of budget planning as it pertains to capital improvement projects, okay, 1, reserve and emergency planning. We've talked extensively about this, again, with the 10 and 15%, with the full review versus limited review, with the baseline funding no longer be an option, et cetera, right? 2 is an investigation. And I can't stress this enough. If you feel like there's some kind of a structural element that requires attention, get an investigation done. There's so many other things that sometimes we just open up, and there's all kinds of, like, even in Central Florida, right? It's stucco, we open it up, wood rot everywhere. I mean, there's all kinds of things that are happening on these older buildings where an investigation is crucial, right? Then number 3, you actually move into a design and sealed specs. This is where you have to look at this stage as mandatory. It's obvious. Okay, first we got to know what we're fixing. We got to have all the specs and the drawings, the structural drawings, in order to even put it out for bidding between vetted contractors. 4, it's exactly that. Sealed bid procurement. Okay, at Stone, we run a process where if the board does not have a contractor that they have a relationship or they know and they trust and they've done successful projects in the past, we recommend. And then we bring vetted contractors. We do individual or joint walkthroughs depending on where the association is. And after the walkthroughs, we basically make sure that the board has an apples to apples comparison on the scope and on the price, so that, let the best man win, so to speak, on the sealed bid. And then at 5, you're looking at the contracting phase. This is where there's a contract, obviously, with your engineering professional, but also with your general contractor, financial controls that you have to have in place as a board. And then 6 is beginning of the work, right? This is where the construction project, whether it's concrete restoration, roofing, or any of the items that we mentioned, begins. And this is where we monitor, work hand in hand alongside the contractor, making sure that, again, warranty, specs, OSHA, safety regulations, installation and manufacturer procedures, they're all obeyed and they're put in place so that we do this project once, right? And that's kind of the lesson that we were hoping that we're going to get with Pedro. Pick the right contractor, make sure you vet them hard, and then do the project once, right? And you never have to worry about it again, at least for the next 10, 20, 30 years. And then the last thing is closeout. Okay, this is where we have our punch list. We have all kinds of things at the end where we break it down with the board all throughout. By the way, I forgot to mention, all throughout the construction phase, we do weekly Zooms. Whether it's our firm or any other owner's rep or oversight firm, make sure you have that communication, right? Make sure that you understand where the project is, at what stage, what's completed, what you guys have paid as a board on the pay applications, and etc. Right? So make sure that the weekly Zoom or the phone call or the meeting in person, whatever it is, it's established, that you have that open line of communication, and you have somebody representing you, obviously, on behalf of the board. So, and then on the closeout, again, making sure that all the items are in place, making sure everything was done correctly, up to spec and code, and up to installation and warranty standards, and making sure that the job is done properly. And again, a couple other things that we see here on the stages of these projects. A bid without an investigation is a guess without a signature line. It's something that you have to just always look back at. What was investigated? What's looked at? Are we comparing apples to apples? Is this even the same scope? And what are the things that are being added? The best bid without specs just means that the lowest number for an unknown scope. And again, this is going back to the beginning of the webinar where, again, shop on price, pay twice. The cheapest usually ends up coming back to bite us on the back end. And then you pay for the work in place, right? So on the pay applications, this is where it's huge to have an owner's rep or somebody representing the board, whether it's a construction manager like Stone does or an owner's rep, right? Where you would verify every single pay application and make sure that, okay, let's say the contractor says it is 30% installed. Well, how do you guys know as a board if it's 30% of the railings installed, right? We have to make sure that you have somebody watching every step along the way, not beating the contractor on the head with a code book, right? That's not the goal here. The goal is to be partners, is to run a very streamlined project. But again, to call things out if it's 29 or 30, if it's 25 or 30, right? So that the board knows exactly what they're paying for every stage of the project. And then really monitoring, when you look at it from these 7 points as a board, it's not really a cost. It's how you actually keep collecting. It's how you basically preserve the values of your units, how you make sure you run a tight ship when it comes to a project, a concrete project or a roofing project. And then basically you continue being in good standing. Okay, a couple other things and things that to keep an eye out for, right? When the number does not work, operating budget is the first bucket, right? We gotta rebid it, trim it, renegotiate the contracts, the cheapest money first. So basically what that means is you gotta look at 3 possible buckets, okay? How to fund a construction project, a restoration project, and that's obviously out of the either operating, the reserve account, SERS account, or a loan or a special assessment, which again, a lot of times it's not really wanted, obviously. So, but again, they're both real options and they have real pros and cons. And again, having a professional kind of weigh those pros and cons for you, it's the right move, and price them out before you pick, right? So again, doing nothing, guys, the bottom line here, I see the hand, Steve, doing nothing will just cost you the most, right? So always look at what's ahead. How are we going to fund it? Are we actually going to do this project? And if we are, okay, what's our priorities? What's our goals? Like, what do we want to accomplish? Yeah, Steve.
Sorry to interrupt your flow. I would, maybe sort of tongue in cheek say there's a potential 4th bucket, right? Which would be, figuring out why you're needing to make these improvements, right? Who could be legally responsible for funding them, and consider legal action. I say it sort of tongue in cheek. It can't necessarily be relied upon, right? You can't budget or budget on you need $4 million to make a repair and you've got a claim. You can't budget on that coming in, right? Litigation is very uncertain, and claims process rarely gets you 100 cents on the dollar. But it is something to consider, especially if none of these buckets are really panning out and you have a legitimate potential claim.
Yeah,
Guys, I want to
huge.
involve Kathy in this conversation if we can. So, especially when it comes to the loan or special assessment, Kathy, can you just, I'm sure boards constantly ask themselves this question. Should we borrow the money? Should we take it from our unit owners? Can you shed some light for our board members and managers with giving guidance on, how these decisions should be made and what can they look at in order to determine what the right direction might be?
Well, as we were going through the last set of slides, my thought process was about that flow, right? The steps. And where does talking to a bank fit in there? And I would say the minute you determine that you have a project and you may want to consider financing, I would start looking at the things that the bank is going to look at when and if you get to the point that you want to look at financing. I would look at my delinquencies. I would make sure that they're well below 10%. Some banks only want to see 5%. We're at 7. Those are things that you can clean up in advance for your association before you're even to the point of speaking to a bank. You want to look at, what does your rental situation look like? Do you have a rental cap? The banks are going to look at that kind of stuff. You're going to want to look at how much money do we think we may need to borrow. So I guess your step 3 and 4, when you start getting the bids coming in, is a good time to start talking to an association bank about what kind of terms they can offer for you. Get bids together and then make your decisions. There's a lot of communication that should go on, in my opinion, with the association to see how everyone's thought process is as your ownership. Do they want to participate in financing? Or do 98% of your people just want to write a check? You can do Survey Monkey type stuff. You can do town hall meetings, just, get with your ownership, see how well they're going to support the idea of going for an association loan and see what that kind of feedback is. And give yourself some options that, you don't ultimately have to take the loan, but knowing that you have the ability and what you present to your owners are all of the options that are available, I think is an important, responsible board course of action.
And then just from the loan standpoint, are there times that you would recommend a line of credit versus a loan for these types of projects? Like at what threshold would one
Well, your
product be
lines
better
of
than
credit,
another?
lines of credit typically have to be paid off and cleared annually. So if it's a short-term project and you can pay it back really quick, lines of credit are great. Now, we offer lines of credit on the front end of construction loans, right? So say you came to us and you need a 7-year loan because you're doing all the roofs, but you need a year to complete that construction. We'll do a non-revolving line of credit for that first year where you just draw when you get invoices from your contractor. And that way you're paying interest only that first year. Once you get to the point, so say you took out a loan for $1 million, it'd be an up to $1 million. You draw, your loan is finished at 850, or your roof is finished when you get to about 850,000. Now, when you go into a term loan, you're turning it into a term loan at 850,000. So that piece of line of credit is very helpful on a construction project to give you that time at the beginning to know what you're actually borrowing from the bank.
Yeah, that's really helpful. It sounds like a good stepping stone if you're running, if you don't have the cash flow, you come in with the line of credit to help fund the actual project and then convert it to a structured product once that project, well, after that year is completed.
Correct. And something to always look for is make sure that you don't have any kind of prepayment penalty. When you're working with an association bank, you shouldn't. That way, if you guys decide, or the next board decides in 2 years, hey, we've got the money, let's just pay that thing off. You shouldn't be penalized for that. It's just something to look for when you're comparing banks.
Sure. And I'm just
Excellent.
curious from my own standpoint, with rates the way they fluctuating lately, have you seen rates creep up a considerable amount, or are they sort of stable?
They seem to be creeping up right now. The way that we price our loans is typically based upon the treasury. So a 5-year treasury, 7-year treasury, 10-year treasury plus basis points, right? So if you're looking at the trend and you look at the treasuries over the course of the last couple months, they're ticking up right at the moment. Don't have a crystal ball to tell you what they're going to do in a month, but that's what I've been seeing in the last couple of months of providing term sheets.
Okay, thanks. Euro, back to you.
Excellent. And Kathy, going back to your point about, I mean, honestly, if the board is all in sync and membership is obviously following along, we recommend looking at your banking professional, your association banking professional, and contacting and really starting that process as early as the first RFP. You get the RFP, you look at what's going on, what is the list of repairs, and immediately, if that's the route that we've decided to take, let's go ahead and get that process started, right? Even if it's just in the beginning, just to be able to get something like a small deposit to get the project going, and then work on the rest. It is so important to be proactive with this. It's crucial.
I think it's
Okay.
also important, having been through this myself as a board member, to have your association attorney involved from the very beginning, because your documents are going to tell you a lot. Do you have the right to borrow? Do you need to do an ownership vote? Are there some things you need to do to be prepared to even get to the financing? Having your attorney at least review your documents for you, help you write the language to prepare any kind of vote that you need to do through that process is important too, because you don't want to get to a point with the bank that the bank's ready to loan you money and you find out, oh my gosh, we didn't do the ownership vote and now we get a delay for 30 days and we lose our interest rate and all those things. So to me, having the association attorney involved was critical for us anyway as a board to get through that process.
Exactly. Streamline the process. Absolutely. Bring in your legal counsel for sure. A great point there. Okay. We talked a little bit about those three buckets, okay, and really what the cost is of getting it wrong. Okay, a couple things, right? Insurability, your direct DNO coverage, and your property renewal are both on the line. Again, this is something that we see day in and day out with associations. Value, of course, we talked about it a little bit earlier. If buyers cannot get a conventional loan, the value of the units comes down on average. Cost, preventative. Again, guys, I cannot stress it. We've seen it up to 30x, the corrective cost versus compared to the preventative cost, right? The preventative maintenance being 30 times more affordable than corrective, or sometimes we call it reactive maintenance. It's huge. And then liability. At the end of the day, as a board, we have fiduciary duty, basically to act on behalf of the interest of the association, and this is something that again has been brought to light with last summer in 2025, where with HB 913. So there's a lot of this is not like to really kind of create some sense of fear or doom and gloom. No, it is just to be aware of what's at hand in this climate right now with multifamily. So
Yeah,
these are the
just to jump in for 1 sec, because this is a really important point when it comes to insurance. Every community takes directors and officers coverage to protect the board members, as you should. To be honest, you'd be out of your mind not to serve on a board that didn't have directors and officers coverage. But you must know that that DNO policy is not going to defend you if you are not following the law. So if the board makes decisions that are not in compliance with the law and the community gets sued because of it, the DNO will not protect you. So it's not just about following the rules because you have to follow the rules, or it's not just about it's about making sure you protect yourselves as members of that board, that you can defend the positions you're taking because you're following statute. And I can't stress that enough, because I have these conversations with communities about, oh, well, the DNO will protect us. Yes, the DNO will protect you if you made a decision that was, you made a mistake. It happens. That's what it's there for. But not if you're not in compliance with the law. So please keep that in mind, everybody.
And there's also well, I was just gonna say there's also a good point, to Kathy's point, which is you've got help, right? You've got rely on your experts, rely on your insurance and your banking professionals, rely on your construction and engineering experts, rely on legal counsel, big point. That's what it's there for. And it's there to protect your association, but also give you guidance to protect yourselves as board members.
Huge distinctions both. And again, we cannot stress it enough when it comes to making these decisions, to look at everything. Again, go back to the 3 pillars. Everyone just always look at, okay, what's the legal landscape, what's my insurance landscape, and what's my banking landscape. And if you consider them and you have them, you're aware of them as a board, you're in good shape. Okay, what to tell your board, right? So baseline is a disclosure. It's not a recommendation. Okay, so Florida requires the baseline plan in your study. Again, going back to that second slide, guys, Fannie and Freddie will not lend against it, right? So again, that's on the conventional side, on the consumer side, but it is very important to understand that tightening of the funding requirements. HB 913, again, the Florida Transparency Act, we've talked about it a little bit. It shows the least amount you can put in and still stay above zero. The law makes us show it. It's not our advice. It's basically what we have to show. Again, the GSE is rejected. Budget at baseline, and buyers in your community may not be able to get a loan. And then last but not least, the bar keeps rising. The minimum goes to 15 in January. Again, I know we had a lot of questions on this. This is something that's brand new. It hasn't even really happened yet. So we'll see kind of what the ramifications are and what the enforcement really is. And then your study staying under 3 years old. So looking at every 3 years at the very minimum, at the very least, to have that updated reserve is a must. So SIRS, so structural reserve study or traditional reserve study, the advice is the same. Fund the biggest amount that your reserve professional is recommending in the study. There's a couple other questions. Really, when the board says we cannot afford it, we cannot afford the full recommendation. The bottom line here, and kind of speeding up the movie ahead, you basically pay either way. You could do steady contributions now, or later. Unfortunately, you might be facing special assessments and lost buyers of these units. So we can phase it, we can pool it, to kind of soften that blow. But where you end up does not change. So a couple examples here, or an example here where the monthly reserve before for an association that we work with, $431, $250 after we did a real capital plan, a real capital improvement plan. It just, again, goes back to the same point where the proactive boards, the boards that look at this stuff ahead, are the boards that actually end up avoiding huge assessments and God forbid disasters down the road. They pay less in the long run. We see it time and time again. If anyone goes on our YouTube channel, there's a couple live testimonials and stories from board presidents and members where, oh my gosh, yes, this was a huge burden in the beginning. We didn't even have our reserve study updated. We needed to do, we had a construction defect litigation happening. We had to obviously allocate that amount of money towards a restoration project. We did not have approval, yada, yada, yada. And then come to find out that we started doing these projects and we started kind of grabbing the bull by the horn and doing little by little. Now we're actually earning interest, and now we're in a way better position as a board. So it's very important to know. Okay, a couple things here as we kind of start getting ready to wrap. Why one accountable party wins. And I won't spend too much time, but again, at Stone, we're one of the very few, if not the lone, as far as I know, I think we're the lone company right now in Florida that started from the insurance background with property damage claims, and now we're a full service engineering firm. But as a full service structural engineering firm, we also do the project management side, where we bring in that owner's representation on behalf of the board. We look at the actual project, the construction management of the project as one of the biggest things where a board is misrepresented, and sometimes it's just not smart and wise to just lean on your contractor alone. Not that they're good or bad, it's just that there's so many things that end up getting overlooked in the middle of the project, okay, which is where a lot of these mistakes happen, and of course that's where we help. So again, we know the numbers. We went to school, we got the text and the specs, but we're really focused day in and day out on communication, on project management, on working with your contractor hand in hand, and really keeping them accountable. And it's kind of like, when we were all in school, when the teacher was watching, we all did our homework, we all did our test better. And so there's so many examples that we can associate that to. So the three fears, okay? So if you're looking at the GCs, the developers, and the owners, right? For the GC, the biggest fear is very simple, right? It's that liability. Okay, so when you look at, if I'm a general contractor and if I'm looking at an engineering third-party engineer who's going to come into this project and be an owner's rep, or really be a project manager, construction oversight person, a good engineer is the smartest lawyer, sometimes we say, right? Like it saves you mistakes. A good partnership can actually flag things early to the contractor and make sure that his crews fix them. And now we document it, and now we have a better outcome for the board, and we have a unified front. So we keep GCs off the stand. We obviously, again, on the flip side, for the developers, a lot of times when you look at new construction, it's all about speed and understanding where sometimes when you lean on a smaller firm, you could really get the benefit because there's no drag from the big firms that are engineering firms. You don't have to wait months to get an answer that we typically see in our branch. I mean, I hate to say it, but it is the stigma when it comes to engineering is sometimes non-responsiveness and a little bit more of a timeline. With us, we're a small unit. We move nimbly, we move quickly around your interest as a developer, as a board, right? And for the owners, again, you volunteer, but not for this, right? So concrete restoration coming back costing 10 times, 15 times, 20 times more if we don't take care of it early on is something that we highly educate and teach and share with the boards that, listen, let's avoid assessments. Let's be proactive about this. Let's get ahead. So every association in the room, right? Again, I don't know what the final number of attendees is, but they're gonna have some kind of a capital project, right? In the next 5 years. The only question is which story you'll tell. Hey, we were the board, unlike Pedro, right? In his situation where we vetted our contractors. We made sure we have a great scope. We know how to go about funding. We know what our reserve requirements and the new timelines are. We know all these things, and now we have a smooth project. And now we've extended the useful life of our building, of our structural elements, but also we've contributed towards raising or keeping a high value of our units as we look in the future. So everybody has the same fear. Again, we unify it all under one roof, and we try to really take that advisory role and just share that common experience with these boards. So last but not least, okay, this is the last slide for everybody. So just another small reminder why we're telling you this. Again, we unified the trifecta, as we call it. Okay, so as structural engineering firm, we do owner's representation, project management, and then we do engineering of record, of course, on the structural side. We also have electrical engineers, mechanical engineers, and geotechnical as well. So basically, as an owner's rep, this is where we represent your board. Okay, it's all about kind of almost like a GM, general manager approach on a project. How is the budgeting looking like? What are the timelines? Is this project going along, moving along well? Really kind of making sure you have that point. As a project manager, the biggest thing is really the scheduling and the Gantt charts. We do Gantt charts on every single project with every board, where we look at the project and we look at each stage and what are the number of weeks and what are the dates, and how we look at being proactive and maybe beating some of these deadlines instead of just meeting them. And then, well, of course, we look at the bid and the schedule. And then as an engineer of record, this is where really it's all about the stamp and on the drawings and making sure we look at every pay application, again, very important, and also every change order where we verify it. We don't just accept it right off the bat. If it is necessary, we obviously explain how and why, and we make sure that it's installed properly. But if it's not, we challenge and we put that out in front of the contractor in order for the project to really move according to that budget that we set, according to the timelines that we set. So, and again, on the reserve studies, and to take a step back in 2024, which was the deadline year, and then it got extended 25. Those 2 years, Stone was responsible for 1,176 clients, so almost 1,200 associations that we did a traditional reserve study or a structural reserve study for. And of course, our background is in insurance. So to kind of tie it all together, right? It's, we've written numbers for a decade, coming from the insurance claims background. Now our focus as a firm is, again, running the work that protects the building, protects your insurance standing, and also your unit values. So all in-house, this is what Stone is all about. So, Peggy, I want to kind of hand it back to you at this point. Maybe any questions? Daniel, I see your hand.
Yeah, thank you, Uros. Fantastic presentation. Of course, you guys have a tremendous amount of experience and knowledge in this field. Let's get to some questions from our audience. I'm going to go just in the order that they were presented and tackle them one at a time while we still have some time. So this one is a little bit unique. I'm going to tell you right off the bat, this first question is going to be very unique to the association that's asking the question. But since you have this expertise, I'll throw it to you in case you have an answer you want to offer. Someone is asking what a reasonable cost of a SIRS 10-year study and inspection would cost for a smaller mid-rise association of 85 units and a small clubhouse pool. The reason they're asking the question is they've gotten quotes from 10 to 50,000. So there's a huge spread that they've gotten on quotes for their SIRS report. Do you have any opinion of where that number really should play out, or would this just be, you got to get quotes from different providers?
I appreciate the question because it's almost like a coaching job, right? It's an ungrateful job, right?
Yeah.
Because if the team plays well, it's never your fault. And if the team loses, it's always your fault. I would say for 85 units, this is, again, a very small association. We've in the past, and I'm not even really shy of disclosing, anywhere between usually 4 to 6K is what we have priced our associations. Again, it does come down. Also, there's a couple other complexities. For example, location, proximity to water, different types of structures, maybe complexities, right? Like it could be 85 units.
Right, construction type, of course.
Exactly, right. Construction type, is it access points? Is it complex for our engineer to go out, and do they have to do extra steps to be able to get on these elements, right? But this should not be, I have never heard $50,000 for a reserve study. So I don't know who issued that quote, but that is not a good quote.
Yeah.
I'll tell you.
So it seems like the answer to this individual's question is contact StoneBuilding Solutions and let them give you a quote.
Pretty much.
Okay. Next one up. This is a little bit of a different angle from Dom. Dominic asks, there was a law that passed that permits aren't required if under a $7,000 limit, and he's asking whether or not this law has now passed so that it's not required to go before an ARC can deny or approve a project. In other words, is the state of Florida's permit level dollar amount, has that passed to your knowledge?
Not to my knowledge. I have not heard that that's passed the 7K threshold.
Okay. Yeah, I think we're still waiting for that one to be put through the legislature and get determined. Next question. This one is about elevators. They want to know if elevators, I guess they didn't, maybe this was earlier before your slides. Of course, elevators should be in the reserve study. But basically, although the question is, what about elevators? Although elevators are not included amongst the statutory SIRS reserve components, they are association maintained capital assets for which major repair, modernization, or replacement costs can easily exceed the $25,000 threshold applicable to non-SIRS reserve components. If elevators are not included in the statutory SIRS reserve study, what are those future repair and replacement obligations evaluated and funded? Are they included in a separate non-SIRS reserve study or another reserve funding plan?
Yeah, it's a good question. You got to look at anything that impacts the structural integrity of the building that's over a certain amount, and obviously elevators are in that bucket in that conversation. I would really highly advise that there's companies like Clarkson and Warwick that we had on the webinar before with Peggy that just provide a free consultation and look at, first of all, how old is the building, how old is your elevator systems, really what are the things that you have to do if it's just an update on a few elements, is it a full-on modernization? But again, these are just free consultations. Again, our specialty and expertise is really the project management side, but we're not elevator consultants.
Okay.
Yeah, I would say, Daniel, I'm jumping in. I don't know the budgeting or the reserve requirements relative to elevators, but from my vantage point, you want to put some money aside for your elevators. You want to be looking at your elevators. I mean, the person who asked the question probably already knows. They are a major component of your community. They're very important. They're very expensive. They're very complex. So if you are forecasting and you are trying to put your funding together, it's definitely something to keep an eye on. And you know, as Uros mentioned, we did do a panel recently with Clarkson Varick. They're very competent, and you know, they could probably, you know, it's sort of like building your team, building your expert team. Get them out there, have them take a look, have them guide you. You know, and again, it goes to the insight we talked about before, is rely on your experts. Rely on, you know, you're a board member and you take this job as a volunteer, yet you get hit with all this information, and you got fiduciary duties that you got to comply with it to boot. Rely on your experts, and you're here, right? You're listening to this, so you're already taking the first step. So contact those people, have them look at those issues.
Yeah,
absolutely.
By the way, back to the point before
Daniel,
on the. Go ahead,
Daniel,
Uros.
one quick. I'm not sure if it was part of the question, but it's not in the SERS, but it is in the traditional reserve study. If that was the question, obviously it's not. It's recommended, not legally required, but yes, elevators are included in the traditional.
And just jumping back to that question from before on the requirement for a permit. One of our members of our community here, Alex Zavala, jumped in and said that it was signed into law on May 7th and effective July 1st. Florida House Bill 803 exempts single-family residential construction projects valued under $7,500 from local building requirements, and streamlines private provider inspection timelines and restricts homeowners associations from demanding government permits for architectural review. So thank you, Alex, for jumping in with that. And as he pointed out, it is specific to private individual homes. Peggy, you had your hand up. Did you want to jump in?
Yeah, I just wanted to say that, you know, you should really rely on these consulting firms or companies that are involved in the information that you need for your maintenance, and not your maintenance man that's on your site. Because a lot of times associations try to save a nickel by, you know, oh, well, I'll have my maintenance guy take a look at it. He's mechanical, but they just aren't experts in that particular, especially elevators. I can't imagine putting the burden on a maintenance manager or supervisor to the level that you need to support the maintenance of an elevator. So I would highly encourage you to, you know, refer to even a roof consultant, not just the roofer. You know, the consultants are managing the hen house. Okay, you don't want to use somebody necessarily that does the work, but you want somebody outside, you know, looking in and not relying on even your property manager. Your property manager is supposed to be managing your property. They are not schooled in every single facet of construction, and they shouldn't be held accountable for that either. And you might be making a mistake by trying to incorporate your property manager to be your project manager, to be your maintenance overview, and so on, because they need to be managing your property. So those are just some suggestions that I've learned over, you know, working with management companies where they put the burden on the wrong people rather than paying a few extra dollars or paying twice, like Uros says, to find out, hey, we really needed, you know, X number of dollars additional, and it saved a whole huge repair versus somebody just putting a Band-Aid on it a maintenance guy just to get you through. That's different than a repair job. So, but I just encourage you to use your consulting firms.
Okay.
Absolutely.
Next question, and this again, this is going to be individual to individual buildings. Philip, your question: how much coverage should be built into the budget for significant concrete and paint project? That's not really a question we can answer globally, right? That's going to be very unique to your individual association. So again, shoot Uros or Tara at Stone Building Solutions an email, have them come out and take a look. Is the best answer we can give you on that.
Or
Lorraine,
just
go
the
ahead,
info
Uros.
line. Yeah, just the info line. I'm going to toss it in the chat for everybody. Just info at StoneBuilding. We'll take a look at it. Just give you
Perfect.
a free.
Yeah, even better. The Stone Building Solutions emails in the chat if anyone wants it, and their phone number as well. Lorraine asks, in a condo that's only 2 stories but has structural issues, suggestions for pushing a proper reserve budget regardless of the increases. I have forced general separate from structural, just so the owners can see priorities. I guess the question is, how do you get everyone on board with doing a reserve study, even if it's only a 2-story building? And if I understood the presentation correctly, it's required anyway.
Yep. Yep. It is. It's required for any condo. Again, any stories, any age. I will just maybe dive just for a quick second here. If you divide it by the number of unit owners, this is really not a big cost, guys. I hate to say it comes down to like a salad over dinner, right? For a lot of the associations, right? It's really a small cost that's going to give you guys so much peace of mind. At least you're going to know what the stakes are and what you have to plan for, et cetera, right? I mean, we have so many times where we've been part of board meetings. We actually, as part of our process to be able to present our proposal, we show up, whether it's Zoom or in person. It comes out to literally like $23, right? Just to be able to have a comprehensive SIRS plus traditional so that you can look at all of your building elements and fund it. So may not be the ideal answer, but it really is a very small cost, and just go ahead and do it instead of discussing it forever.
Yeah, I think there's still a lot of confusion around the Fannie Mae, Freddie Mac requirements, and that these questions keep cycling around and around. And I honestly, I don't blame everyone for it, because the rules have changed several times, and then it's not easy to understand. It's also unique to specific lending, not all lending. Someone is simply asking if we know where we can get copies of the Fannie Mae guidelines available from. Can anyone point to a specific location maybe we can include in the presentation afterwards? Uros, are you providing slides to everyone after? Okay, so maybe
Yeah,
we can provide them with a resource.
Yeah, we'll go ahead and add that on to it. So every attendee has a copy of the slides. Obviously, we'll add that piece of information there as well. But yes, as of August 3rd, it is official. And then we have that January 4th timeline.
Perfect. Uros, Edward said you did a great job so far, and he would like a little bit more explanation of pipelining, if you would.
Okay, this is going to be a challenging one because we've had a lot of vendors come to our own company meetings, and obviously pipelining contractors. There's new techniques, but it is basically a plastification from the inside that it's obviously a reduced cost and basically extends the useful life. And of course, it comes at a cost, but it is not. It is just a fraction of the cost when you look at traditional replacement or repair. So there's other things that people are trying lately. I've heard about ballooning technology, if I'm not mistaken, and different materials with it. But it's really doing it from the inside, putting something in place. The shell comes off. You have a new pipe, and now you're basically you're lining your pipes, and you're good to go, and you don't have any kind of issues, leaks.
Yeah, Edward, I suggest you go to YouTube and take a look. It's a pretty cool process. They pump this plastic material through an existing pipe. It shoots out the other side and essentially becomes the new interior liner of an existing pipe and seals that pipe from any cracks. It's especially helpful when you're dealing with cast iron, because that's been so problematic. But go take a look on YouTube. You'll see all kinds of videos on it. Anonymous question. How do you know when you need to check the stairways and railings? Are those only for inside or outside as well?
Good question. Really, we focus on the outside, on the exterior stairwells. And again, a lot of it is, I mean, I would say about 80% of the complaints of the actual proposals we get is unit owner complaints, whether it's wobbling, whether it's instability, maybe there's a little bit of wear and tear on the actual threads, whatever it may be, right? If you feel like there's a good amount of time that's passed and you have an older building, it might be a good time for you to take a look at them and maybe do a walk. Again, we do free walkthroughs where we can kind of look at just specifically that element, just the stairwells, and then advice.
Oh, terrific. Tara actually gave us, she's our behind the scenes coordinator over here. She put into the chat just now, Tara Stone, the CAI article. She put in the Freddie Mac guideline and the Fannie Mae guideline. So anyone looking for that information will find it in the chat right now. Thank you, Tara. You should be the one moderating this webinar. Okay, let's see what else we got.
Backups.
Next
What?
time, for sure.
Okay. Barry has a question. Is the minimum reserve amount that must be funded to meet the minimum Fannie Freddie reserve requirement 13.05% of the total assessment income if the reserve study alternative is not being used?
It's 15.
Yeah.
I'm not sure where 1305 we're getting that number. The minimum reserve amount that must be funded to meet the minimum.
Yeah. Oh, I'm sorry. I clicked it off. All right. Well, we're not really sure we understood that question, Barry. Next question. The slide indicates the SERS reserve requirement applies to buildings 3 stories or higher. Does the requirement apply to only buildings with 3 habitable stories or higher? Yes, that's the way it's written. Is 3 habitable stories or higher.
Correct.
Lorraine, not a problem. Okay, anonymous. Oh, that someone dropped in the update. Edward thought that pipelining was a financial term, not a plumbing term. No worries. Okay. I think unless there's anything else in the Q&A, Uros, that you want to tackle.
No, I think we've covered a good amount. I think for the purposes of this webinar, really looking at the budgeting requirements, the new legislation, and really looking ahead towards your capital improvement. We've covered plenty. Again, I want to thank you for everyone's time and attendance and really being here. And thank you, Daniel, Peggy, Steve, Kathy. I really appreciate you guys being part of this webinar.
Kathy, do you have any last thoughts or takeaways you want to give our audience?
Because we're doing pipeline.
Oh, we can't hear you again, Kath.
Forget it then.
I'm sorry, something's wrong with your mic. Steven, you got anything, last thoughts or comments for our audience?
Sure. Yeah, I think Kathy was making maybe a pipelining joke.
Oh.
Man, I was looking forward to hearing
it. Send it in the chat, Kathy. Maybe we'll get it.
Yeah, just thank you for letting me be part of this. Uros, great job as always. I think Uros' passion in presenting this is a real reflection of his company. We're all here for you and appreciate being here. Appreciate the opportunity. I hope you all have a great weekend.
Yeah, and I'll just reiterate that for everyone as well. Everyone on this, hopefully you all know by now in our webinars, everyone who's either a sponsor or a speaker Everyone will be glad to have conversations with you, even if you're not a client, even if you just need a little bit of guidance and help. Please, please, please feel free to reach out and ask. Get as much information as possible. The whole goal of these webinars, the reason Peggy does this, is to educate all of you and our community to make sure we all know what's going on and to have the resources we need so you're not alone and you're not making these decisions in a vacuum. Please utilize those resources. And with that, I'll turn it over to Peggy for final thoughts and to take us off the stage.
You got it. So, yes, I echo the comment on passion. You're just amazing, and their slides were dead on. That was just an awesome presentation. Thank you to Steve and Kathy. Your input as experts as well in your field is very helpful. And Daniel, you certainly have a great background with the insurance too. So this is what I try to do for everybody. I try to pull together experts and people that know the business and know what you need. And on this sponsor sheet, everybody's contact information will be on there that I send out following the webinar. I do have several webinars coming. I will put that at the bottom, the schedule of my follow-up email to everybody with the recording link and the slides. I just want to mention one in particular. Next Friday on August 28th, I have the Emergency Management Team Director for Tampa, John Antapas, is giving a fire rescue hurricane preparedness final presentation. It's for any city in the whole state of Florida. Okay. Yes, he is putting it on, but he's going to be talking about their program after all the things that they've been through with their experiences, giving you some pointers and also the resources that Tampa has. And I mention this because maybe some of your cities are smaller. Maybe you don't know what resources to have in play for your community. And I think this will be an outstanding presentation with good information for everybody as residents as well as the CAMs and also the board members. So I just want to also say what I got out of your presentation, Uros, was that communication is huge. I recommend town hall meetings for a lot of things after having myself work for a management company. This way, the residents know where their money's going, and it's much easier to get them to comply and to go along with, what you need to do, not extras, but just, even some of the minimums. With insurance, of course, Daniel, I want to reiterate, taking pictures before and after and videos are always helpful, especially with their projects. Take them as you go along. Use drones, use whatever you need, but to have those pictures available so that Stephen can help you if there's any litigation following. So, but thank you, everybody. Once again, I thank you to the CAMs and the board members. We do appreciate you choosing our webinars. Have a great weekend.
Bye, everyone.